Welcome back to the Am I Rich Yet podcast, a weekly podcast for millennials and Gen Zs where we help you save, spend, and grow your money smarter. Welcome to episode 22. This is an episode titled, Do I Need a Financial Advisor? My name is Georgia. I'm one of your co-hosts. I am a Gen Z myself, currently completing my master's of business and navigating my personal finance journey.
I'm Rob. I'm George's dad. I am a recently retired financial advisor, and I'm here to help you make smart decisions with your money.
Awesome. Well, welcome to Am I Rich Yet? If you've been listening to some of our previous episodes, you'll have realized that we've been doing something at the beginning where we ask each other a non-finance related question just to get ourselves warmed up, get the audience warmed up, and well, today I'm going to do something different. I'm not going to ask a question per se, but do you have your question ready for me?
I do.
Okay.
Georgia, what do you like most about your dad?
Oh, that's a really great question. A lot of things just came to mind,
Okay.
but the main thing is that our producer, who's my mother,
Rolling her eyes.
rolling her eyes behind the camera. I feel like I can rely on you in any situation to come to you and know that I have your unwavering support no matter what I'm going through. Even if I've made a really big mistake or if everything is going well and you're like that reliable figure in my life.
Hey, good.
That has nothing to do with maybe your personality when it came to me.
Okay, that's good with us. Okay, what's your question for me?
Well, it's not necessarily a question to you, but what I'm going to do is I'm going to read and get your reaction on, I'm going to comment on the best comment we've received after we released episode 1, and I'm also going to comment on the worst, I'm going to read the worst comment we received. So, one of the best comments that we got sent in, which is really niche, but a friend, someone in my network who reached out to us saying that she is a editor for the Globe and Mail and actually writes for the retirement section of the Globe and Mail. And so she asked if we wanted to be featured in this, and I thought that was a really cool.
Very good. That'll be fun.
Yes, and just this morning, I'll read another one. We had a note come in that's from someone I don't know, friend of a friend. Hi, sorry for the random message, but just had to send a note to say I love your podcast. Such a smart and creative way to get our generation thinking about money. Love the story that brought this to life, and you and your dad are great.
That's good. I like that.
So we went through the 2 positive ones. Now I'm going to read one of the negative ones.
The haters.
The haters. And you can kind of get back to the haters. So we had one person that wrote in. They wrote in, between the 2 of you, you sound like you have one brain cell.
Oh, that's really nice. Good. Okay, well, I guess we are from the same family, so we got... Now, they didn't say that we had a bad or a weak brain cell. Maybe we got a really powerful brain cell. So anyways,
But before you go, I actually have to say we didn't receive that negative comment, but Eric and I were in the kitchen this morning laughing our butts off, thinking about negative comments
we could have received...
that we could have received.
Okay, so we didn't really get that one.
And I thought you were going to get a bit more riled up, but you stayed pretty calm. So I guess you let it roll off the back.
I'm used to the haters.
Okay.
We're always out there.
Cool, I'll put my phone away and we can jump into this episode. So what are we going to be talking about?
Today we are talking about, do you need a financial advisor? And what we're going to do is we're going to go through and explore all the different ways of getting financial advice and what my recommendation for this group is. Okay. Where am I coming from? What's my point of view? I've been a financial advisor for the last 34 and a half years. As of June 30th of this year, I gave up my securities license and my insurance license. And that is a little helpful because I don't have to answer to anyone anymore. I don't have to answer to my compliance department, to the firm I used to work with, or anything like that. So this is really unbiased advice. I'm free to say what I want. The last thing, and I didn't know whether to say this, but over my time as an advisor, I had 100% clean compliance record. In fact, about 2 weeks ago, I received a call from the compliance officer telling me what a pleasure it was to work with me because she never had to worry about anything that we did.
Wow.
And that was really nice. Not every financial advisor has a perfect track record. Most of them do, but not everyone. And that's where I think the reputation comes with some of them.
Totally. And that's something to call out. I mean, I don't have a clean compliance record.
There you go.
So be proud. Working on mine.
Maybe I was too boring. My job as an advisor was really simple. Very early on in my career, I figured out my job was to look after my boss. Who was my boss? My boss was not the company I worked for. My boss was my client. They're the ones I was responsible for. So at the end of my career, I had 900 different bosses. And my job was to look after them financially. And every decision I made, I had to look after them, one else. So let's look at some of the different ways that you can get advice today. Number one, you can do it yourself. You can decide which investments you want to set up your own account. And most of those you can do through an online brokerage. And we're going to get into the advantages and disadvantages of them. Next up is robo-advisors. So relatively new. They've probably been out, I don't know, maybe 10, 15 years. And basically, it's a more automated system. It's still somewhat doing it yourself. And when you work with a robo, you either have a choice of doing it yourself or using one of their portfolios. They don't provide any advice other than the portfolio. And today, I don't really think you need that advice.
Right. And I hadn't heard the term robo-advisor until we started talking about it. So what are some examples of robo-advisors?
In Canada, probably the biggest one would be Wealthsimple.
Yeah.
Questrade would be another, although they're sort of half and half. They're half an online brokerage and a half a robo-advisor. But they would fall into that suit.
Okay.
And then what happened is most of the banks launched their own robo-advisors and then they backed off most of those.
Okay.
Next up would be bank advisors. So that's someone who works directly in the bank and they're working that 9 to 5 shift at the bank or whenever the bank is open. And that's what they do. They look after regular bank clients. Then you get full service financial advisors, which I was. And I'm not going to mention the firm that I was with, doesn't matter. But full service financial advisors could also work at the bank. That's the brokerage arm of the bank. Okay. And lastly is fee for service. So fee for service is where you're just getting advice. They're not helping you manage the money. Okay. And every time you get advice, you pay for that advice.
And are those people that are giving you the advice typically attached to banks, or are they?
No, they're
independent?
not. So let's start going through each of those that we've gone through and touch on the highlights and lowlights. So advantages of doing it yourself, really low fees. Today, you can manage a global portfolio for 10, 15 basis points, maybe even less. So that's pretty cheap. In other words, next to nothing. It's relatively easy today on the trading platforms. You can do it on your laptop, your phone, whatever. Easy to set up the accounts, and you can get started literally today. Within probably half an hour, you can be opening up your account and buying your first investment. It's really simple. Pretty good reporting. The technology today, it's good. You're going to know how you're doing, how much you put in, how much it's grown to, what your rate of return is, et cetera, et cetera. What I don't like about them, disadvantages, they make money when you trade. When you are moving that money around, that's how they make their money. And they make money also on your cash balances. So in between trades, when that money is sitting in cash, they're earning interest on that money. They're paying you a stipend, a little tiny piece, but they're keeping the majority of it. And there's absolutely no advice. So you're kind of on your own. And that is great when things are good and the market's going up. It's not great when the market's going down, unless you are spending. I always say if you want to do it yourself, you need the time, you need the training. So you need to become a bit of an expert on investing. And number 3, you need the temperament to stick with the strategy, because more money is lost during down markets because people get scared, get nervous, they change their strategy, they think they need to do something. So that is do it yourself.
Great. And I have a couple questions.
Yeah.
Because, you raised some points there. So one thing, one of the disadvantages you mentioned, there being absolutely no advice. I understand that. When you mentioned, there's a fee associated, or there's people making money off the cash that you have sitting around. Isn't the reality that no matter how you're doing it, if you're doing it yourself, a robo-advisor, if you're using a financial advisor, like, someone is making money somewhere off it. Like, financial advisors are making money off their client's business at the end of the day.
Absolutely.
So are you raising that disadvantage that, they want you to trade, not to deter people, but just we're bringing all the cost associated with it isn't so detrimental, but we're just raising the disadvantages to the surface? Or is it
because trading is detrimental to your wealth? The more you trade, and I've used this example before, remember that bar of soap?
Yeah.
The more you use it, the quicker it disappears.
Yeah.
And trading's the exact same.
Yeah.
If you're trading your portfolio, trust me, you're not making a lot of money. You're losing money.
Right.
It's like if you're in Vegas and you're gambling more, Vegas wins. And it's the same with portfolio management. And I'm saying this from experience. Mm-hmm. There's also a ton of evidence out there that the more you trade, men are worse than women. Men trade more than women. They don't do as well as women do investing because they trade more. They feel they need to do something because there's a new president, there's a new tax, there's higher interest rates. Like, they make stupid mistakes. Anyways.
Let's golden nugget that quote. Women invest better than men.
Okay, there you go.
Okay,
that's your golden nugget.
One other question. I know timing and everything, we can.
Yeah.
You mentioned that to do it yourself, you need to somewhat become an expert. Now, when I started,
not necessarily an expert, but you need to know enough to know what you're doing.
So question, and I'll ask my question through an example. When I started my first job out of my undergrad degree, I was like head over heels, felt like punching way above my weight. You said, Georgia, you're in a new industry, new role. You're going to be uncomfortable for 12 months. And hearing that gave me this sense of stability in those first 12 months that I was like, buckle in, this is going to feel tough. This is going to feel like out of my league. And after that 12 months, it will suddenly feel a bit more comfortable. Hearing this, what you just said about investing, how you need to teach yourself, educate yourself, and become an expert. How much time would you say, could you give a number around that so people can say like, hey, it's okay if in 3 months I still don't feel like I know exactly what I'm doing? Would you say it's something you should be studying, educating yourself on 5 hours a week through YouTube videos, etc., and then starting small, getting bigger?
My take here is, and this is why I'm going to be recommending a lot of people do it yourself. I think it's a great thing to start with.
Okay.
Because what you might figure out, I really like doing this and I'm good at it, or I hate this. So I'll give you an example. When I started in my business, I spent my first week telemarketing for new prospects. I despised it. I wasn't good at it. I was nervous on the phone. So I learned I wasn't going to be doing that in 1 week. And literally the next week I hired telemarketers to work for me.
Yeah.
And so it may be the same. You may be wanting to hire an advisor after you start.
Yeah.
But start without one. If you make a mistake on $10,000, it's not the end of the world. If you make a mistake on $300,000, that's going to cost you. If you make a mistake on $1 million, that's going to cost you a lot.
And our listeners are going to have different thresholds for what they can lose. Like for some people, losing 100 is a lot. Approach with caution. Maybe they should be more conservative at the start. But you said after a week you knew you didn't like telemarketing. What's the time frame someone should give themselves?
But let's start with at least a year.
Great.
Okay, so let's look at some of the other options. Okay, number 2, robo-advisors. So the advantages, if you're not just their trading platform, they're going to put you into a portfolio. So you do a risk profile, they'll put you into a portfolio, and you're going to pay somewhere between 25 and 50 basis points, which is between 1/4 and 0.5% in management fees to manage that portfolio, okay? Today, I don't believe you should be paying that amount of money to have your money managed because there's no advice there other than the portfolio. They're not telling you how to maximize your RSP and, that you'll save this in taxes. Like, you're kind of doing it all yourself. There's great tools online, but you're doing it all yourself. So you're not getting someone saying, Georgia, you need to be doing this, or your savings isn't enough, you're falling behind. Okay, so robo-advisors are good. They have really good trading platforms. I like it. They will build that portfolio for you, as I said. Disadvantages, you're not getting the advice. They do prefer that you trade. So you're going to be getting all kinds of communication talking about buying this and selling that because they want you to be active. That's how they make more money. Remember, every business is not a nonprofit organization.
Yeah.
You mentioned it earlier. Everyone's in there to make a dollar.
Yeah.
That's why they're in business. The robo-advisors tend to stick to their own managers. Initially, when Wealthsimple started out, they had all these great outside managers, and very quickly they moved to their own internal managers.
Yeah.
And that was all profit-driven. Okay? Next, let's go to the bank advisors. You go to your local bank, whatever it is, one of the big 5 banks in Canada, and in that branch, you're going to find a bank advisor. And there's a lot of them. There didn't used to be many, now there's a lot of them. Okay? They're typically salaried. Some are commission-based. They have sales quotas. Typically, they're fairly aggressive, and they can only use their company's own product. So you need to go, if you're going into a vacuum store and it's a Hoover vacuum store, you're already seeing Hoover vacuums.
Yeah.
And so that's a bit of a conflict of interest. I also know there's pretty aggressive sales targets that you need to hit there. So that means they're selling more than advising, which I don't like. You'll get advice on the portfolio, and they will do a rudimentary financial plan for you. They typically have a lot of clients, so they can't do detailed planning, and we'll talk about how they move up. Their fees will be higher, quite a bit higher than a robo-advisor. Okay? So you're going to pay closer to 2%, 2.25% for most of them. Some of the fees, a lot of investors think they don't pay anything to their bank advisor because the fees are hidden. Now that's starting to get more exposed because the requirements in the industry are making people produce statements that show their fees at the end of the year. Okay, but I'd say a third of the clients are not even looking at it. Or 2/3 are not even looking at it.
Yeah.
And I know that from my own clients. 2/3 of them never looked at what it actually costs for the portfolio.
Yeah.
And the last thing, I think there's a big conflict of interest. So that's my take. Next, we're going to go do full service financial advisors. So that was the role I was in. Basically, what you're doing, you're setting goals, you're building a portfolio, and you're doing the planning. And the value is really in the planning.
Okay.
So your fees will be higher, less than a bank advisor. The banks do have full service brokerages, financial advisors that are different from the in-branch advisor. These are typically top advisors. They look after clients with $1 million. And a lot of them are really good advisors. And their fees will be similar to what you can get from some of the independents. So nothing wrong with that. How they work is they work on, for every dollar they generate, they get 50% of it, and the bank gets 50% of it. Now, is that a conflict of interest? No, they're somewhat restricted what they can do because they work for a bank.
Yeah.
So let's be honest. What they're good at, they explore all the areas of your financial life. They should be looking at your wills, powers of attorney, your tax returns, your insurance. If they're not, then they're just doing the portfolio thing. So they're either planning and portfolio, or they're just portfolio. You don't want to be paying those high fees if they're just doing the portfolio, because that's going to impact your returns. Most investors believe that a really good advisor is really good at picking stocks or ETFs or mutual funds. That's not true. No one has that skill set because no one can predict it. Some of the best advisors in the country you are going to find in the banks. There's some people there at the top of their game. They're excellent, they're educated, they're smart, and they will give you very personal advice customized to yourself. So that's what's available. The fees may be a little more expensive, but it's worth every penny because they are going to build a plan for you. They're going to make sure you stick to it and really help grow your wealth. The last one, fee-for-service financial advisors. A fee-for-service financial advisor is where you're just paying for the plan. They're not implementing the portfolio.
Okay.
And I think that's the weakness, because you're then in charge of implementing the plan.
Yeah.
So you get this nice 25, 30-page financial plan, and it gathers dust in your desk. And because a big part of it is managing the portfolio too, managing the behavior around investing. It's rare that you can get someone who can take that plan, implement that plan themselves, and manage the portfolio. You're doing a lot of the work. Now, it's cheaper to go to one of those guys because you're not paying on the assets that you have.
Okay.
You're just paying a flat fee, might
Yep.
be $2,500, $5,000.
Because they're just doing the planning.
They're just doing the plan. Now, you can go back to them every year and pay another $2,500 or whatever it may be. Also don't like their model. The only way they can make money is to continue to hire, either look after more people or continuing to delegate it out. So, it's just me. That's just my take, my personal take.
Yeah.
I didn't view them as competition when I was a full-service financial advisor. We had a question.
Great. I'll read out this question. My portfolio lives almost exclusively in Wealth Simple, FHSA, RRSP, TFSA. Do you have any advice or recommendations on investing through one of the online platforms?
So I'm going to say to this individual, you're halfway there. You've got the account set up. You're doing the right thing. Shift away from using their portfolios to using globally diversified ETFs. You're going to cut your fees in more than half just by that move alone. You don't have to change anything else. You don't have to open up new accounts. You just make a shift away from their portfolio. They'll try and talk you out of it. As long as you can stick to that portfolio, you're going to be very successful investing, and your returns will be higher. After fees, your returns will be higher, and in all likelihood, your returns will just be higher.
Got it.
Okay? Next up, signs that it's time to move to a full-service financial advisor. You're earning steady income. You've got money to manage. You've probably got at least over $250,000. You're unsure where you want to start. You really just hate this stuff. Math, investing is not your thing. You need to have someone help you there. You've just bought your first house. You're married. You've got kids. All those things, whatever it is, you've received a big inheritance. That's the time you should get advice. Get someone to help you with this. Even you name every athlete in the world, they have coaches. Why are we shying away from this? You know, there was one comment, I think it was Quest Trade had a commercial that basically said, why would you want to work with your parents' old fuddy-duddy financial advisor? Why would you want to work with someone with 30 years experience who's made a ton of mistakes over the years and knows how to do things right?
Yeah.
Like, it was just arrogant.
Good marketing.
It was.
Quest
It was
Trade.
really good marketing, right? It
Yeah.
brought in a lot of business for them.
And it's
But-
sparking conversation.
Well, hey, listen, in my first 5 years as a financial advisor, I made a ton of mistakes. After, 10 years, I made very few mistakes. Like
Yeah.
20 years, I made no mistakes.
Yeah.
So experience helps. Yeah.
And your advice is to start doing this themselves.
Yep.
So start that process. I think step one is setting up those accounts, considering the budgeting. That episode we have on how to build a budget, we talked about the minimum 15% savings. Then we talked about which accounts that should be going to based on where your income level is at. All those steps are kind of the first steps in your own.
Definitely.
And I think something that came to mind, because I think for a lot of listeners, that even sounds daunting. Bringing this conversation to the surface, this taboo topic of money, but just like there's book clubs and run clubs, I know of a group in Vancouver, actually, that's a group of friends that gets together at the beginning of every year and creates their budget together. And I think, trying to pull your resources, call on a friend. Maybe don't call on the friend that says they know everything about investing.
Right.
They probably don't. But bring together a diverse group of people with different backgrounds who are maybe listening to this podcast also, and do it together. There's power in numbers. I always feel more comfortable when I'm working on something new or practicing a new skill when I have other people around me that you trust. You don't feel embarrassed to ask questions around. And I think a lot of people might resonate with that idea. Call upon a partner. Would I have had the confidence to start this podcast without you? No. But you and I together done such a good job. And I think it could be the same with investing and working on these new skills you're building.
Great. Okay.
What are we going to talk about next week? We are going to talk about how to grow your income.
Okay.
on
Next week.
episode 23.
Next week, lots of ideas on growing your income.
Great work.
Thanks.